There's been a lot of discussion about the time period that should be used to make some of these determinations, economic determinations, and the year of 1926 seems to be the popular one. We didn't choose that year, but proposed to choose that year. But there's a lot of things that's happened since 1926. You know, we had a Great Depression, we had World War II, we had a Korean War, we had a Vietnam War, we had oil embargo, and then the railroads were deregulated in 1980. Almost totally deregulated. So there's been a lot of water over the dam since 1926, and it concerns me that we would use data and use an evaluation period that is that long and does not really reflect the real world that we live in today. The world has changed in many, many ways. We here who live in Washington, D.C. certainly realize that. I'm not sure that's true in a lot of other places, but in any case, if you had to pick an evaluation period for the cost of capital, what period do you think would make a lot more sense from an investor standpoint?
Well, I'll say all of those numbers, to state the obvious, are historical, and as investors, we don't look at history much at all, except to give us some insight for potential events that may have happened. But unless you believe that history is prologue, I don't think most investors weight history the way that the CAPM model or potentially some of these other models do. And so when we make our judgments, and I think the difficulty of being an investor is that in part you're a fortune teller, and in part you're looking forward, trying to figure out what the appropriate returns given all these panoply of risks. And while history, to the confusion about time frame, is important, in reality we use those as some data points, but it's always forward-looking. So if we're standing here today, we have to figure out where things are going to be in 5, 10, or 15 years as long-term investors. And that maybe has some relevance to past history, but very likely, as you point out, the rules have changed, the games have changed, the players are different, the economy is different. You know, China was not a force throughout most of that data set. Right? So one major force is completely out of the data set. You look at the structure of the railroads, completely different today than they were before. You look at regulation, completely different, well, except for the last 25 years, prior to 1980, completely different today than it was. So you have so many major deviations to base our decision looking forward based on those numbers. Again, we use it as a reference point, but by no means do we actually run calculations to look forward. Makes your job a little bit more difficult, but I'm trying to stand here to say that I think at the end of the day, most people are going to use this number as an expectation of what we would place dollars to invest. So if Jim Young or any of his peers comes to us and wants to invest more rail infrastructure, and that's what I'm hoping to convey.
So I don't want to oversimplify it, but we either have a choice of looking backward or we have a choice of looking forward.
Correct, and as an investor...
And investors are looking forward.
That's all we look at.
Okay, thank you very much.
Commissioner Mulvey?
When you look forward, you don't look forward as if you were born yesterday, however. I mean, basically, when you're looking forward from the perspective of the knowledge developed in the past. So you do have that as a something to look to base your judgments on. Would you say the railroads are more risky or less risky industry than they were 25 years ago today?
Well,
risky investment than they were 25 years ago.
Well, at the precipice of 25 years ago, probably it would be more difficult to say. There's some very, you picked two endpoints. But if I were to weight it, say, 5 or 8 years ago, I would say they're much more risky today. Particularly, I can list a few things, and some other respondents have listed a number. But from our perspective, regulatory and legislative risk is much higher today than it ever was. I think most people would agree. And that can change the rules of the game. So
a lot of industries, of course, face regulatory risk in the sense of environmental regulations and others which will affect their ability to do business, the automobile industry, for example. Do you think that the railroads face specifically more regulatory risk or legislative risk than other industries?
Not categorically across all, but definitely across most.
Okay.
And when you look at major industrial industries, for sure, I believe that's the case.
Now, are some of these risks temporal in the sense that you see what legislation finally comes out of this in the next Congress, and you see how the board here finishes its rulemaking procedures, and you have a new set of rules. Those risks at that point then go away. Would that be true? And
Again, it depends on, now we come to the investor's time frame. So as long-term investors, if we're looking 5, 10, or 15 years out, ideally the longer we can invest, the happier we are. Right? It's significantly easier to invest for a long period of time than it is for a short period of time.
And although you're a hedge fund basically, but you do feel you take a longer term view than is ascribed to most hedge funds. Is that correct?
Correct. It's unfortunate that the term hedge fund has drawn certain connotations. We're an investment partnership, and as fiduciaries, our investors expect that we'll invest the way we told them we would, which is we are long-term fundamental investors. We happen to be labeled a hedge fund, and again, people can interpret that how they wish, but our time frame and the level of effort and energy and hopefully cooperation with the companies we invested is such that we believe the best outcome will come over that longer period of time.
Another hedge fund that's invested heavily in the railroads, especially certain railroads recently, is the Children's Investment Fund. And they have advocated, they have said that the railroads are, especially some railroads, are underpricing their service, and they should raise their prices substantially. Is that the view of Atticus as well?
The way I would answer it is I think the railroads provide substantial value, and it's very difficult to generalize because I'm sure there are some customers, and clearly there are some here today, that feel that the rates don't meet the value that they're being delivered.
They're not paying enough?
Well, and then there's people on the other end. And I think this industry, based on its history and based on the complexities of running so many different businesses to literally the backbone of the U.S. Industrial sector and actual commercial sector, you end up with a huge range. So I want to be careful not to give a blanket answer. That said, I think there's significant opportunity for the railroads to increase their levels of service and in that framework raise prices if the price meets the new level of service. Like all businesses, deliver more value, customers will reward you for it. And I think that's the opportunity we see, and that's what we're concerned might not occur if this cost of capital calculation and the replacement cost discussion goes a way that might harm that investment.
Thank you very much.
Mr. Walken, I've got a couple questions. You were here for the previous panel, I assume. I think I saw you in the audience. You heard the discussion amongst the railroad executives that they basically did not come forward today with an industry proposal on replacement costs. Can I assume as a large investor you'll be chatting with them about that? And since it seems it's in your testament, that's an important concept, and we're, I think, open to looking at it in due course or hearing anybody's ideas, but we just haven't heard a lot of detail. So
it's very difficult to do. So we're the first to admit that. Again, we come from the standpoint that it's so divergent that it needs to be taken into account, or we're going to create the wrong incentives. Again, if we believe that this industry doesn't need any more capital, this discussion is somewhat moot. But if we believe that the industry needs more capital and we want to attract the capital, to be using the wrong denominator in the return on investment will lead to the wrong end result. And so we've looked at a lot of different ways that this has been solved, and we put some in our written testimony. I think one of the better examples of something we might propose, again, we'll have to look at the relative strengths, but is the Australian Regulatory Transmission Authority that has done essentially a market value-based costing for those regulated assets. And so you don't take replacement costs, which clearly, as the commissioners have pointed out, is not a realistic assumption. No railroad tomorrow, no investor expects the railroad tomorrow to replace 100% of their assets. But we do expect that every day they look at a given mile of track, a given locomotive, or a given freight car, say how much is that car worth to somebody else. And when they're going to deploy it, we would like them to make the decision based on that market value, not the value that the accountants tell them. Because again, they always have a choice. They can get rid of a freight car or they can add a freight car. But they always should be thinking about today's market value. It doesn't make sense to use what the accountants say.
And just to follow up, your testimony was interesting in that it did point out the ways that accounting standards and treatment can sort of possibly be either manipulated or have maybe distorting effects. You talked about the possibility of a merger, for example, or
I think I talked about the purchase accounting. Yeah.
Yeah. Can you elaborate on that?
Sure. So again, I'm not an accounting expert. I would leave that to better experts to explain. But I am aware that in a purchase accounting of a set of assets, that accountants write up the book value of the assets to the price paid. I'm being simplistic, but that's basically how the math works. And so I don't know if I reuse, but I could use, say, if Warren Buffett was allowed to and purchased 100% of Burlington Northern, the day after he purchased it, all the assets would be written up on Mr. Hunt's books to the effective equity price paid. And again, from that day forward, the STB would then be looking at that number. Nothing's changed. The exact same management, the exact same customers, the same rates, but yet you're now measuring on a different denominator. Again, I was just using it to highlight the fact that accounting has a number of strengths, but I think most accountants will agree that there are many shortcomings. And as investors, one of the things we in practice do is identify those shortcomings and make adjustments for them.
Let me call your attention to the handout that came with your testimony. You talked on page 4. There's a table that's headed "Market Spectrum of Risk versus Return," and you show here that, or you present here that railroads under major categories of risk fall, in your view, as high risk for liquidity. Moderate to high for loss of capital, high in the area of liquidity, high in the area of legislative risk, low on inflation, moderate on interest rates, and very high on catastrophic risk liability. Looking at that, what would you, and then that calls my attention to the beta risk factor we need to be looking at in this proceeding. What would you, do you have any suggestions on the right beta number or range there? Because if I look at this, I would possibly come to the conclusion this should be, higher than the sort of industry average of 1. But we've heard some consensus in earlier panels that it's somewhere in the 8.5-ish range. And so I just want to tease that out a little bit.
And I think, I can let the other panelists articulate what they said, but from what I heard, they were talking about a historically derived beta. And beta is, again, I want to be clear that we don't use it in our analysis. So the output is what we use in our analysis, or what would be the output of this. So we think about how much we would invest and what return we would expect on that. So I just want to put it in that context.
But you do risk assessment all the time, but you just don't go through the full.
We don't think about beta, but yes, if you want to draw an analogy, beta would be the best analogy in the CAPM model to what we use to evaluate risk. So as a proxy for risk, yes, without question, they would be higher. It doesn't make sense to us that I can invest in some major Fortune 10 companies, let's say with a beta of 1 at a higher rate than 8.5% on one extreme, and if anything, I would expect a greater return than those companies. Again, I'm trying to put some goalposts there because all this discussion ends up coming with ranges, but as investors, we always have a single commodity, dollars, that we're trying to put somewhere at the best risk versus return. And this is a simplified version of how we would look at the world. And what's clear to us is that the goalposts are such that where the current CAPM model, as proposed, would line up the rails doesn't make sense. You essentially can invest the same money at a higher return for lower risk. Case in point, Warren Buffett yesterday bought $2 billion of TXU bonds at an effective return of 12%. That was yesterday. If you go to him and ask him for $2 billion at a promised return of 8.4% for the railroads owning an equity investment, where he may lose a substantial portion of his capital because he's an equity investor, it just doesn't reconcile. So.
Thank you. Any other questions from the board members?
No.
Thank you, Mr. Watkin. You're dismissed. We appreciate your being here today and your testimony.
Thank you very much.
We'll now call up our final panel, Panel 5, Mr. G. Paul Moats from the Association of American Railroads, Mr. Nicholas J. DeMichael from the National Industrial Transportation League, and Mr. Robert D. Rosenberg, also from the Western Coal Traffic League. Welcome, panel. I think we'll start with Mr. Moats. Mr. Moats, the floor is yours.
Thank you, Mr. Chairman. Vice Chairman Buttry, Commissioner Mulvey. It's always a pleasure to be in front of you, and I'm sure it's more of a pleasure for you when I'm on the last panel. So glad to get it going. A couple of things real quick. I think this became clear as Mr. Romick and others addressed your questions about